All right, I think I'll round out this session here and talk a little bit about Arca. My name is Jerald David. I'm the president of Arca Capital Management, and many of you may or may not have heard of Arca before. But before I get going, I too would like to just put up a brief disclosure as well. It talks a little bit about what I can't talk about as well, reinforcing this is solely for informational purposes. There are a couple of things I wanted to talk about today. The first thing I want to talk about is a little bit about the Arca U.S. Treasury Fund itself. There are a couple of key components here that I'm going to work through. The first one really is what the fund and the fund structure really is. The second one I'm going to talk through is really what this thing is we're talking about, which is blockchain transferred funds. And then a final thing I'm going to talk about is going to be the security token. If I can, maybe you guys could take the conversation outside in the hallway. Thanks, guys. Appreciate it. So we've created something pretty special here at Arca. And Arca itself is an asset manager. And as an asset manager, we manage funds for outside clients. We have two different divisions. We manage about $450 million worth of assets. We specialize in the digital asset space. We operate two different funds on the other side of the business. And the returns that we've had are quite remarkable, as you'd expect through the digital asset space. Over the course of the duration of about 3 years since we launched the fund's returned well over 1,000% for our investors. The other side of the business that we have is called Arca Labs. And Arca Labs is super interesting. And Arca Labs is interesting because what we've done is we've tried to create vehicles using blockchain technology that leverage existing structures, right? And that sounds super complicated and kind of crazy as well. But essentially what we've really done is we've taken a look at the way that history has unfolded, and we've tried to take a lot of these different structures, and we've tried to create vehicles for the future. And by vehicles for the future, I mean using tokenization and creating a security token like no one else has done just yet. As I said before, the majority of our team comes from traditional finance. My background's in infrastructure. I've worked at some of the leading exchanges in the world. I've built several exchanges around the world, and I've been involved in digital assets since 2015. The rest of our team, as you can see, are kind of quite accomplished in their own rights. So what is this thing that we're talking about? And there are three key components here that I'm going to talk through. The first I said before is the structure, and that structure is something we're referring to as a block transferred fund. And if you're familiar with securities, if you're familiar with different structures that have existed in the past, and you're familiar with the 40 Act, this will probably all make sense. And what you see on the slide over here on the right are some of the more traditional structures that people are aware of. Things like mutual funds, things like exchange trading funds. And those were all created under this 40 Act that was created essentially by the SEC to provide investor protections. And we'll talk about that in a little bit. But essentially, when you look at the evolution here of mutual funds to ETFs, essentially ETFs came about because there were a couple of efficiencies that were created, lowering operating costs, making things less expensive, obviously. Creating intraday trading where that didn't exist before, allowing for the transference of different assets between people. And essentially, when you take a look at what those different elements are, we've built upon that. We've taken things like an ETF, and imagine if you could actually take a wallet, you could take a token, and you could send it from your wallet to someone else's wallet, and you could do that any time of day using the blockchain. And that's the peer-to-peer transferability that we'll talk about in a little bit. We reduce the needs for intermediaries, things like broker-dealers, banks, expenses that exist regarding like wires and things of that nature. Those inefficiencies are all really eradicated with reference to the BTF structure. And then the final thing that I think is really important is that this operates outside of traditional exchange hours, right? When you talk about how exchanges have evolved, when you think about the different practices that have been adopted by different funds and different elements that have transformed finance, we've been beholden to banking hours. Well, kind of peer-to-peer transferability removes that. And some of the different infrastructural plays that you'll hear about later on this conference and these exchanges that exist, they're operating 24 hours a day as well. So that obviously is a path towards the future. So what we've done essentially is we've created what's known as a wrapper. And a wrapper essentially is a structure. And when you look at that wrapper, think about it as a ability to create a portfolio of securities. And you can put anything into that portfolio. We've talked a lot about real estate earlier today. We've talked about equities and kind of wealth creation. Think about any security that's out there, and think about the ability to place it, like I said, in this wrapper, to then create something that has some sort of a transferability component to it, but also has all of the safeguards and standards that you'd want to have if you were trying to create something and transfer something in that kind of a way. So as a pilot and a POC and working with the SEC, which we did for 3 years, we've created something that essentially takes this wrapper and we wrap it around US Treasuries. And we did that as a proof of concept. And we did that because they're very, very well known. They're backed by the full faith and credit of the US government. And this product was really created for a couple of different reasons. And this product was created to maintain a stable value. It was created to offer interest in good times, and there's interest that can be given back. So think about someone in some part of this room over here was talking about Celsius before. And they were talking about how they've got their digital assets stored at Celsius. And they're doing that because they're getting yield. Essentially, this is a yield component that's inherent to it and that's built in as well. So you own the token or the security, and ultimately if there's yield that's generated in good times, then that yield is deposited back in kind to you as the owner of that token. And we did this also because the market for this isn't necessarily me or Anthony or many of the people in this room, but the market for this really are large-scale financial institutions. And we've created this product to appeal to folks who are looking to get involved in the digital asset space, but don't have the comfort, that can't touch something like, let's say, USDC, or can't touch something like Tether because the regulatory overhang doesn't exist. There's risk involved in owning those assets. And if you're at Goldman Sachs or JP Morgan or Credit Suisse, it's going to be very difficult for you to try to go to your risk committee and say that, yeah, we should put this in our portfolio and we should absorb that risk. This provides protections that are granted under the SEC, and those protections ultimately are bestowed back to the client and the token holder. So what is this fund and what is it all about, and how is this in this wrapper that I'm talking about? Essentially, we took, like I said, plain vanilla short duration US Treasuries. And that's what the prospectus that we file with the SEC mandates that we hold in that wrapper and in that portfolio. Minimum investment for the fund is $1,000, monthly redemption period. So that essentially means that you can buy this from the fund. It's a closed-end offering, and it's an interval fund. So essentially what you're doing is you're buying from the fund on an ongoing basis. And then the fund periodically responds back and says, look, if you're interested, we'll accept redemptions from you and we'll cash you out. There's another element of that we're working on with the SEC right now and have been working with them on since the beginning of the year. And that's for allowing for trading on ATSs. So the folks that you're seeing in this room, the folks like T0 and Oasis Pro Markets and INX and even Texture to some extent, the goal would be that ultimately as these products are created, they'll be listing on those ATSs and they'll be open for investment from others. Now that's very, very different, right? Because what we're talking about here is creating a fund that you can subscribe directly to, and then you can buy on an exchange, and that we can send around the world to anyone who's been whitelisted before. So think about the efficiencies that creates, and think about buying a wisdom tree fund, having exposure to a gold ETF, and then simply being able to take that out of your wallet and send that to someone else. So it's a very, very, very compelling case, and it's something that we believe is the future of finance. So why is it that we even did this? It's really expensive. It costs us like $750,000 to $1 million to operate on an annual basis. We're required to have a whole host of different service team providers, folks like services that Fortallo provides as a transfer agent, auditors and fund administrators, et cetera. But we're doing it because it uses the existing regulatory structure that works, right? And this regulatory structure is what anyone who's been following the ETF movement and anyone who's been watching what's been happening in this space with reference to ETFs, well, the ETF is essentially trying to do exactly what we're doing, but that portfolio or that ETF wrapper has Bitcoin in it. And the regulator themselves have not been, or the SEC themselves has not been open to allowing for approving that. But as you can see through this, they're not opposed to digital assets. They're not opposed to structures that exist. They're just concerned about the underlying that everyone's trying to push forward to them in the form of Bitcoin. So we use the existing regulatory structure, and there's some special protections we'll talk about in a little bit that come from that as well. It reduces intermediaries. As I said before, it gets rid of the bank, it gets rid of a broker, and it reduces your cost as well. We have the ability to shorten settlement times, which is super important as well. You're talking about moving from something like T+2, T+3, to T plus like 10 minutes. And again, that's super powerful when you're trying to analyze things like risk, and when you're trying to have certainty in what your assets are and where they belong. The transferability allows for cross-border activity. So in a point of the future, when we're authorized by overseas regulators, it's conceivable that you could use this stable, this low volatility token, and you could transfer funds essentially from here to somewhere in Asia or in Europe, and you could do that using blockchain as well. And then the final thing is that we've got these investor protections. So what are all these investor protections? Well, the first thing is that the assets are held in trust, and that's super important as well because they're isolated. We're required under the statute to have independent governance. So not only do we have an independent board of directors, but we also have an independent administrator, an independent auditor. And they're looking at what we're doing every single day. And in fact, the majority of the movements happen through these third parties upon instruction from the fund itself. And then the last thing, obviously, is the periodic reporting that we're required to do. And that's in the form of quarterly reports, semi-annual reports, and annual reports as well. The final thing that I would say on this is that when you look at value and you try to calculate what value is, we employ what's known as a fund administrator, and that fund administrator calculates what the value is on a daily basis. And that value is referred to as NAV, and that value has maintained stable at $1 for almost every day since we launched the fund. And that was critically important for us as well, especially, as I said before, when you're looking at the way that some of these other stable tokens that are out there are coming under fire. So we've got this fund, right? It was created under the BTF structure. And then the output of that fund, right? When you subscribe to that fund, when you buy from that fund, you're presented with a digital asset security. And that digital asset security is called Rcoin. And that's what's actually transferable, as I said before. It's a digital representation of a share in the fund. So think of it as buying a share of a portfolio, and that portfolio in this case happens to be US Treasuries. We're working with several joint venture partners, and there'll be announcements coming out over the course of the next coming weeks regarding how we're taking this structure, and we're using this wrapper, and we're actually putting different assets into it. And that could range from real estate, that could range from equities, and that could range from anything that's deemed a security through the SEC. And then the final thing I'd say before is that one Rcoin as well is equal to the NAV, or the net asset value, that's calculated by this fund administrator of the fund. So, how is this different from buying into a traditional fund? And there are a couple of ways that it does. The first is that this is obtained through subscription, which you would get as well. But the difference here, with reference to the Arca US Treasury Fund, is that the subscription is entirely automated. So all the flows of funds, banking and otherwise, happen through the web portal that we've created. The second thing is that shares are delivered directly to a wallet. So upon subscribing, you put your wallet address into the portal, and then ultimately, once the shares are created, which happens after authentication of the funds, verification of AML KYC, and a couple of other elements, those shares are delivered directly to you, and then you could transfer them to anyone else who's been whitelisted previously on a peer-to-peer basis. And then the final thing I would say is that, for us, when we look at what we've created, there are a couple of key elements that we always like to reinforce. The first is that it's SEC registered. There's nothing else like it out there. And in fact, the number of tokens that are actually registered with the SEC are far smaller than the number of tokens that are out there right now within quote-unquote unregulated status. And if there was anyone who was out there that was watching Gensler yesterday, when you weren't here, paying attention to the other presentations that were happening, this would become very clear that this is very much in the purview of the SEC. When Gensler makes comments referring to stable tokens as poker chips, I think it gives a true sense as to what direction this industry is going in and how things are ultimately going to be regulated moving forward. It's a familiar structure, I said before, anything under the 40 Act. I shouldn't say anything, but I would say by and large, something under the 40 Act provides a level of comfort for large-scale financial institutions to participate in. And by way of just perspective here, take a look at what you've got going on at Wall Street, right? You've had a lot of noise that's come out of Wall Street. There's a lot of POCs that are happening, but there's not a lot of activity from the trading standpoint. There are a couple of investments that have happened from the large-scale investment banks, but the tokens and the tools that are at the disposal right now of those trading entities don't pass the test that they need in order for them to allow for broader adoption. This portfolio is a low volatility instrument, which essentially means, and that was by design, and essentially means that it can replicate a US dollar if necessary. It's transferred peer-to-peer, it's interest-bearing in good times, and the technology is derived from smart contracts that are written on the Ethereum blockchain. Well, this has been great so far. I really appreciate Bertalo for hosting this event, bringing a lot of, and I heard the term, like-minded individuals together, share ideas and talk about things, and we appreciate giving you a little insight into what we're doing at Arca. So thank you very much, guys.